For Kiwi and Aussie expats, deciding what to do with UK property isn't just sell or keep. It's tax, FX, family politics, mortgages, inheritance rules, and compliance paperwork, all rolled into one complex puzzle. Because the flat you bought years ago as a simple investment, it may no longer be all that simple. Your London property might still be making money, or quietly losing value through tax, compliance costs, and currency swings, while two tax systems watch from opposite sides of the world. So, here's the reality. Option 1, sell. Clean, simple, final. You sell the property, pay UK capital gains tax, clear the mortgage, and walk away with cash in hand. But here's the trap. Many expats still think the gain is calculated from what they originally paid. But that depends on when it was purchased. If you owned the property before April 2015, HMRC lets a non-resident base the value to its 2015 market price, which can massively reduce the tax bill. Missed that? You could be making a voluntary tax donation. Then there's the 60-day reporting deadline. HMRC wants its paperwork and tax surprisingly fast. Miss it, and penalties start stacking up. And if you live in Australia or New Zealand, their tax systems may also want to look at the gain. Option 2, hold. Sounds easy. Collect rent. Let the mortgage slowly disappear. Maybe keep a London base for the kids. Except being an overseas landlord in the UK has become less attractive. Mortgage interest relief got gutted. Compliance rules have been fattened. And from 2026, making tax digital means quarterly reporting for many landlords. So that great investment from 10 years ago. After tax, fees, accountants, management costs, and admin, the yield can start looking a bit more average. Which raises the real question, are you holding the property because it still makes financial sense, or because you've grown attached to it? Because one is a financial decision, the other is an emotional one. Option 3, pass it on. This is where things can get tricky. A lot of families think gifting the property to the kids solves inheritance tax problems. Sometimes it does, but sometimes it creates brand new ones. Gift the property but keep using it yourself? HMRC may pretend the gift never happened. Gift it with a mortgage attached? Whoops! Stamp duty can appear out of nowhere. Gift it to your child? HMRC still treats it like you sold it at market value, meaning you can trigger a capital gains tax bill without receiving a single pound in cash. And none of this even considers whether the mortgage lender allows the transfer in the first place. So what's the right answer? If you need cash, selling usually wins. If the property still produces strong net income, holding can work. If inheritance tax exposure is large, passing it on deserves serious planning. But the biggest mistake expats make, thinking this is just a property decision, when really it's a tax decision disguised as a family conversation.